My name is Pedro Barata. I work for CFA Society Portugal. First of all, thank you very much for coming for our event with Nova. We are a group, we are a society which all our members have the CFA certification, and part of our mission is to promote the financial literacy in Portugal. And for that, we have a group of members, volunteers, because they are not paid, that produce events, financial literacy events like the one that we will do today. I would like to thank you, special to Ahmed. Are you there, Ahmed?
Yeah, can you hear me?
Yes. Okay, I will give you permissions to be a co-host. So thank you very much for the organization of this event and send invitations for in name of CFA Society Portugal. So we would like to thank you. I need to read the names because I forget. I would like to thank you to Portfolio Management Club. I would like to thank you to Nova Awareness Club, Nova Women in Business, and finally Nova Investment Club. Thank you very much for all. I hope you enjoyed this event. Before we begin, I would like to do a small advertise. I don't know if someone of you students of Nova have interest in to do the CFA certification. If you have interest, I would like to announce that CFA Institute will do an event only for Portuguese students in July, on 17 of July. And soon we will send you invitation through your club. So if you have interest, please join. Okay, so now, Ahmed, would you like to say anything?
Yeah, I would just like to thank you, of course, CFA Society Portugal. It's such a pleasure to have you, really. We have been waiting for this for so long. I think everyone is interested to know how to start investing efficiently, and we are curious to know more about the products in the Portuguese market, because we need to take actionable steps. I think this crisis made everyone more clear that we all need to start invest at the moment. So thanks for all the clubs, and thanks to you. Appreciate it, and we hope you enjoyed the event. Pedro, I think you're muted. Yeah.
Thank you, Miguel. So I hope as well that you enjoy it. Let me introduce my colleagues that will do the presentation. They are 5. First one will be Luís Jordão, then will be, I think it will be Pedro Marques, then Raúl Afonso. The 4 will be Miguel Jordão, I know, and finally, the last but not the least, Madalena. The five of the 5 have different topics, and in the middle we have 2 sessions of Q&As. So, Ahmed, I will ask you when the Q&As appear, I will ask you to read the questions through the chat. Feel free to interview during that moment. So let's begin. Luís, it's with you.
Everybody, and thank you for listening to us. We're going to present the presentation on financial literacy. So very basic but very important stuff that usually gets missed when we start working and start our professional lives. I'm going to share a presentation for the first part. I think you are able to see it. And we'll start with the overview of why we do this with the mission from the CFA Institute. So you probably are aware of the CFA Institute as an organization for financial analysts, and in our core values are the advancement of the industry, especially in terms of ethics, market integrity, and professionalism. So we want to contribute to society in the best possible way, and the financial literacy for the whole society takes a huge part, and especially youth is where you can have more impact, because you're starting your careers. And so if you start with the right food, it will be a huge advancement long term. The financial literacy project comes from the analysis of the market and the fact that most people actually don't invest. They don't invest in financial assets. They are too afraid of the risks of the financial markets. And I would say, and we have this quote as a introduction to this theme, that Warren Buffett says that risk comes from not knowing what you're doing. And so if we can increase the knowledge of potential investors, then risk is minimized and investments get done. Otherwise, people are just too afraid and they don't start to act. As Pedro was saying, I'll start with the why to invest. Then my colleague Pedro will continue with the savings part of the investment. Without savings, we cannot invest. Raúl will cover the actual investments part of the presentation. Miguel will address some of the issues we might have when we invest, some of the main pitfalls when we are investing with the behavioral biases. And Madalena will do the introduction of investment products that we have available both worldwide, general investments and specific investments for the Portuguese market. We'll try to keep the presentations to 15 minutes. Sometimes it's difficult, sometimes we make it. And we'll have, here is the mistake because we did this one time with the 2 Q&A blocks, but we are going to do all the Q&A in the end this time. And we hope you have questions and use the raise hand to give us awareness of the questions. You can also use the chat, as Pedro was saying. We'll be recording this event, and we hope you have fun with the event. Nothing here is investment recommendation or advice, just education material, and this doesn't. This is only our opinion and not the institutions that we work for or the CFA Institute as a whole. So my presentation comes from the start, why one should invest. We had the first point, to invest or not to invest, what obstacles we have to overcome in this process. And I give you 2 rules that are extremely important long term. In the investment versus not investment, I give you 3 characters. First character is John, and John does not save anything. Everything he earns, he spends. So money in, money out. In the end of the month, there is 0 balance. So no saving, and obviously no investment. It's paycheck to paycheck. Mary, she is able to save and saves 100 euros a month, and she is very disciplined and does this every month, but she is very risk averse. She doesn't know how to invest, doesn't want to know how to invest, and so she just saves 100 euros a month. And Anne is also very disciplined, like Mary, and is able to save the same 100 euros a month, but she has taught herself into investing. She has learned, she takes some time every month, and she has actually started investing. What does this imply in the long term? John is not a very strange character. It's more or less the typical that we have in most developed markets. A lot of people are living paycheck to paycheck, and so their balance after 10 years is 0. Their balance after 20 years is 0, and after 40 years is 0. There's also, I didn't put here a character, but there's also the character that even takes consumer debt, and so the savings are negative, and it lives paycheck to paycheck, trying to pay down debt. So this is even not the worst case. Then Mary, with 100 euros a month, after 10 years, she'll have 12,000 euros. after 40 years, 48,000 euros. And then makes the investment and gets a return on it. And after 10 years, she is already with 17,000, so 5,000 ahead of someone who just saved and didn't invest, and 17,000 ahead of someone that spends everything. But obviously, the longer you can compound your investments, the difference grows exponentially. And so after 40 years, her nest egg is 262,000 compared to 48,000 that she put in. So it multiplied by more than 5, and compared to 0 if we don't save and don't invest. So here we have some benefits of this. Main benefit is security, and feels much more secure to follow her dreams and even take some risks in her career, or do more with her has more degrees of liberty that you can find in a bit of financial freedom. So if she invests and she gets her nest egg with a more significant amount, she gains options to go and follow whatever she prefers. So we have many situations that can harass us. Financial is usually one of the issues that people are more stressed about. And here, because she learned, because she was disciplined, because she saved and invested, she gets on that side much better life. Why doesn't everybody do this? Why doesn't everybody save and invest in a disciplined way? What is happening? What is happening is that we have a lot of difficulty doing this, both in terms of behavioral and in terms of actual amounts. It's difficult to save. It's a stress, and if you don't automate the process, you have some difficulty. I'm going to show you a video that shows some of the issues here. Let me just share here. So this is an experiment. Are you seeing the video? This is an experiment that was done in Colombia, but it originally was made in Stanford, and the tester was with one kid in a room, and he would give the kid an option. You would give a marshmallow, and the kid, 4 or 5 years old, would be told that he could eat the marshmallow. The tester would leave the room for 15 minutes, and if he came back and the kid didn't eat the marshmallow, then would give another marshmallow to the kid. So he would have a 100% return in 15 minutes. If the kid couldn't hold up and wait for the experimenter to come back, he would eat that marshmallow, and that was it. Let's see what happened in this experiment in Colombia.
Hasta para un niño de 4 años es atractiva la idea de tener el 100% de retorno a la inversión en 15 minutos. Sin embargo, algunos de ellos, tan pronto la puerta se cerró, se comieron el marshmallow inmediatamente. En cambio, resistieron el impulso.
So so we have here the difficulty that we all have with our marshmallows. So everybody has their own version of marshmallows, something that we would really like to consume, and we have to delay that consumption to get more in the future. So that is the core of investing. We have to sacrifice. I don't like a lot the word sacrifice, because sometimes we are not actually sacrificing. People spend a lot more than they should, sometimes in things that don't have a lot of value, but there's a mentality of spending everything you got. But okay, let's say that everything is important and you get some utility. You have to sacrifice a bit today to get much more in the future. That's the whole concept of investing. And here, most of the kids ate the marshmallow. 2/3 ate the marshmallow, and 1/3 was able to hold up and get the second marshmallow. And this trait was shown to be also a predictor of success down the road. People with more capacity to delay gratification were better students, usually more disciplined, and they were able to get into the courses that the universities and the courses that they preferred. So this is something that is important for success. And being important for success, you also have the positive that this can be trained. Actually, if you know that you have some reward at the end, for example, regarding investing, if you are aware of that, it's much easier to be disciplined than if you don't know anything. So just being able to learn about the potential and what you can do with your investments will make you stronger in terms of discipline to delay gratification. Then there's another difficulty, this more external. And for this external, I would like to show you a systematic investment here from 76, which my birth year. Let's assume that my parents or my grandparents started an investment, putting aside 100 euros a month and investing in a world equity index. So equity of all over the world, diversified portfolio. And they would be doing that for every month since 76. What would they experience in terms of the portfolio? From 79 to 82, we'd have the second oil crisis and the markets would collapse 28%. In 87, we'll have the Black Monday, and just in one day, the market fell 23%, the biggest one-day loss in history. In 91, we had a war, and the market also corrected. Then, from 2000 to 2002, big bust of the tech bubble, and in these 2 years, the market went down 50%, more or less. The financial crisis, 2008 to 2009, even more, 56% in 1 year and 3 months. Then we have the Troika. Then we had the trade war in the end of 2018. And now we had COVID-19, and in February to March, the market corrected and went into a bear market with a 36% fall. So, putting aside 100 years a month during 44 years during this period with all these negative events, what happened to my investment? Almost more than 50,000 euros were invested, and with everything that happened, the value of the portfolio would be now more than 540,000 euros. So that is the growth of the market, the equity market, with an annual return of over 9%, cumulative return of over 4,700%, and so a very spectacular rise of the markets within all these negative news. Of course, this is also the main difficult part. One of the difficult parts of investing is that we have huge drawdowns in between. So these crises have an impact that psychologically is very difficult to withhold. We would be seeing a portfolio of 230,000 in March 2000, and then would have to watch it fall to 124,000 euros, so half in these 3 years from the tech bubble, and always putting in the market 100 euros every month. Then it would recover, would be a new high of 320,000 more or less, and suddenly it would halve to 148. We have to look at this period, and when we are here in March 2009, we'd have the same amount invested, the portfolio value the same as, sorry, I have here one thing in front of me, as 2003, 2004, and even 98. So 10 years that would be investing 100 euros per month and to get nothing. So this is very tough for many people in investing, and having a long-term perspective is not as easy as it looks in the charts when we are living through it. And so now we'll have the new maximum just before the COVID-19, 555,000, and then this fall, significantly fall and recovery from COVID-19. Obviously, this was not inflation adjusted. If we adjust for inflation, the amounts are significantly lower because we had some high inflations in the 70s, 80s especially. And so just to reference, the amount in terms of purchasing power would be 280,000, not the 540,000. So just to keep in mind. And so what do we suggest for 2 rules that you can implement and that will put you ahead of most people in terms of finances? First is pay yourself first. This is very talked about in personal finance and very forgotten, not applied by many people. If you, and Pedro is going to talk more about the saving part, but if you prioritize savings, you are able to save. If you only try to invest what is left over after consuming everything in the month, you probably won't be able to do it. And the less you have to decide on something, the best in terms of investments and in many things in life. So if you automate, you take that decision out of you, and then you'll be having to have effort to not do what you automate. So you put the effort of doing the wrong thing and not the effort to do the right thing. And then the other part is make your money work hard for you. As we saw before, if you just save, it doesn't take you very far. Probably will lose money to inflation. And so you should learn how to invest so that you can be more aware of the risks, and then you are able to invest in more risky products that will give higher long-term returns, and then it will the money compounds in a magnificent way. So this is what I wanted to share with you. Now I'm going to pass to Pedro. He'll detail the part of the saving part, and thank you for your attention.
Hello to all. Thank you very much, Luís. Let me just share my presentation. Okay, hope you all seeing the saving part. My name is Pedro Marques, and I'll talk about savings. As already mentioned, the baseline of any investment strategy. So I think that using a simple indirect language will help us pass through all of the content. I will have 3 simple messages that I would like to give you and you take away with you. And so let's get started. So we going to start with a very wise advice to measure what we do with your money. Nothing simpler could help us get on our feet. So there's no need to use advanced Excel files or complicated mathematical formulas. The only thing that we should do is basic math. Some banking services and other fintech startups already are offering some free and very intuitive alternatives, so take a look. This is the first message to keep in mind. Quantify what you do with your money. Using a household budget, we believe that it's an essential part of this process, and a simple list of revenues and expenses is sufficient. Don't complicate it, no need it. Let's see if this is true in the real world. So we thought to share with you some conclusions from a financial literacy survey that was taken to the Portuguese population in 2015, which reveals that a high percentage of those who respond plan their financial life using a household budget. This is a very good indicator. About 71% responded affirmative to this, and reinforces our first message. So the second thing that we think that's very important is if the respondents effectively save some money. And this is also true. 59% also save some money. About 40% don't save, and the reason for that is the lack of income. And so we go to our statistics, and we use both Core Data and Banco of Portugal info to share here with you. And for the last 25 years, the gross disposable income of households in Portugal increased about 110%. So this is a huge increase. Let's see about consumption, and using also the same source. We see that the consumption also rises very strongly, about 130%. And looking for debt to households only, we see that we already peaked in 2010, 2011. We are now about 42% above where we started with this series in 2003. And from all these data series, we can at least expect something from savings, and that's that nominally the savings were stagnant all over this period. But we have one big conclusion to take from this, is that the savings rate here in Portugal from 95 to 2018 decreased from about 15% to only 7% now. So this is one of the main problems that we derive from these statistics, and we offer some main advice to you. And this is a basic step. Luís already mentioned, pay yourself first. Prioritize your savings in the budget management you make every month. Seek to automate creating periodic plans or other forms of discipline in order for you to achieve this goal. This is paramount if you want to succeed in investing, and in order to do that, you have to overcome savings first. The second advice that we encourage everyone to take and to carry careful analysis, is what should be considered essential consumption and superfluous consumption. This is inherent to each other, so feel free to consider some of these as essential, and for others will be superfluous. But for Portuguese population, we have about 20% on spending on food and drinks and tobacco, 18% on housing and other utility, 16% in transports and telecommunications, and about 30% in restaurants and hotels. In order to know the best strategies to save in all these essential consumptions, we suggest to follow some specialized TV programs, podcasts, and other media that address these topics. For superfluous consumptions, we should apply some filters to assess whether, first of all, is it urgent or not? Can we wait for sales season, other promotions? Have I compared price thoroughly nationally versus international suppliers? Are those alternatives the only one that meet requirements? Are there any second-hand articles that could suffice as well? So this is intrinsic to one another. So we believe that this is the second part of our conclusion. Balance your budget management, prioritizing your savings, distinguishing what is essential from the superfluous, and finally rationalizing this consumption. In this way, we could maximize our savings. About that, what should we expect Portuguese to save for? Going back to our financial literacy service that we mentioned earlier, we realized that 45% save for unforeseen events, for any emergency, 24% for non-regular future expenses, 21% for purchasing and replacing durable goods, and about 9% for children education on their own retirement. And do Portuguese savers adjust the way they save and invest with the reasons why they save for? Do they try to match the long-term objectives with the long-term financial products that they have available? And one of our main conclusions of this in this presentation is, unfortunately, 19% of the Portuguese have never invested in securities. So this is from the survey we mentioned. And we believe that about 50% of the respondents could be using the benefits of the most varied securities to meet their financial needs, and do not do so for the most varied reasons: ignorance, distrust, discredit in the sector, etc. So that's why we are spreading the word, and we strongly believe that there is an added value for everyone, and that it's possible to grow your savings in a sustainable manner and finance part of our future consumption. That's the main point here to share with you. And this is the last part of our conclusion, is to encourage you all to adjust wisely the investment products available to your particular needs and objectives. For short-term reasons, use short-term solutions, and for long-term objectives, use products with long time horizons. Selecting products with the right time frame and characteristics will allow your savings to grow and strengthen your future consumption capacity. Having said that, we wrapped it up, our 3 takeaway tips, and propose to move on to the next topic, investing. And so, Raúl, the stage is yours. Thank you very much for your time.
Thank you very much, Pedro, for the wonderful presentation. And I think this comes at a great time because right now, after this quarantine, probably all of you are loaded with money because you didn't spend any, right? And you saw your summer vacations were basically canceled. So right now you don't have any alternative to do with your money. So probably you are wondering what on earth should I do with it. So that's this presentation about, and that's what I will try to convince you is to overcome that survey that Pedro showed you a couple of minutes ago, and to start investing and starting investing now. That's one of the main conclusions that I want you to leave here today, is the need for saving, the need for investing, and the need for doing it now the most automated way possible. So did you know I am 28 years old, a bit older than you probably. So if I start investing 250 euros per month, during 40 years at average market return, I will probably have at my retirement more than 1 million in my bank account. And most of you say, okay, that's great, but I will start doing that 10 years later. So 250 per month times 12 yields 3,000 per year, 3,000 times 10. So I lose 30,000. So I end up with 970,000 euros at the end of the 68 years old. The problem is that you forgot to account for compounding interest, and if you account for compounding interest, you have less than half. So this key takeaway of start to doing things now is of utmost urgent and need. Looking now for the kind of investments that you could consider, I will start to simplify it very much. Okay, so we'll look to broad asset classes. Normally, investing is to finance a company or a project or assets. Okay, so normally the company has two sources of funding. One is using the liability, so called fixed income, and the other one is the shareholders' money, so equity kind of investments. On fixed income, it's basically a contract. You sign a contract where you'll receive interest throughout the maturity of the contract, and at the end you receive the principal or the face value that you invest in. And for equities, you receive dividends and capital gains at the exit. The main difference between fixed income and equity is that fixed income, you sign a contract, so basically as a defined maturity, and equity is like a long-term marriage where you cannot exit without a divorce, without a sale. Okay, so basically, while on fixed income returns are much more predictable and in that sense less risky, and in case of bankruptcy you are the first one to receive, equity holders are the last one to receive. Returns are much more unpredictable. You can just distribute dividends if you have profits, and at the end you depend on how much the market pays for your position to receive the principal. So the principal that you invest in ultimately will be dependent whether the market considers that the company worth that amount or less or more. So it's more of a risky position. And in that sense, if we analyzed, I brought here 30 years of history, and if we analyze these two asset classes, we see that S&P 500 is the equity class. So basically, it's a broad-based index of 500 companies, the largest 500 companies in the US, but most of them are very global, like Apple, like Amazon, that you know very well. And you have also a fixed income indicator, which is basically also a global ETF. And then you have the inflation of Portugal in the last 30 years. And if you see for this broad long-term horizon, which is probably very much compared with yours, because you will have time horizon probably longer than that. You will work more than 40 years if life expectancy continues to increase. And you see that for long time horizons, the investment in equity, you multiply the initial investment by 17-fold, while for fixed income, you just multiply by 5. So for this long time horizon, you would lose you'll just get 1/3 if you invest 100% in fixed income compared to what you would get if you invest 100% in equities. The catch is that the equities are much more volatile, and it's very important here that you understand that all of these are nominal returns, so all of your returns should also be benchmarked against inflation. So if you are getting less than inflation, you are basically doing nothing. So if you consider here, for instance, deposits, here I'm consider fixed income with some variability, so some duration, right, and some spread as well. So if you consider investments kind of a deposits, probably will not pay you the inflation. And in that sense, you lose purchasing power, and losing purchasing power is the same of having or yielding a negative return, as Luís also mentioned. So the next question that you probably ask is that, okay, if equities are better, then I stick with equities. Why should I consider even fixed income or any other source of investing? And the catch is that equities have more volatility, are more risky, as I start saying, and you should brace for some turmoil. Okay, so I brought here the crisis that happened since the beginning of the 20th century, and as you can see, there were around 12 crises, so one crisis after 10 years, and as you can see, you should brace yourself for at least a drawdown of 35% on average on this crisis. Okay, but the average is like just the average, right? You have crises like the Great Depressions that were very strong. You lost around 90%, 90 with 9 and 0 of your investment portfolio, and you also have the 2008 crisis where you lost more than half. So this is a investment class that should just rewarding you on the long term, okay? And if you plan to exit on this turmoil, you probably end up losing money, or at least not get rewarding for the time that you were waiting, okay? The next question that I want to address is more or less how long it takes to recover fully from a crisis. So as you can see on average here, again, the average is that it takes around 40 years for you to recover drawdown from a crisis. So at least you should have, on a time horizon basis, a time horizon greater than 40 years to think about investing in this kind of asset class. So this is a very good asset class for long-term investing, but at least for more than 4 years to start investing in. Another thing that I want to also leave for your consideration is that, is it possible to mix a bit the asset class in order to have like some sort of income from the fixed income while having the long-term part more allocated towards equities? And you have here three normal profile from the industries where you have the different allocations. And the key takeaway here, you have the performance that these asset classes have, these investment strategies have in the past, considering the S&P and fixed income index. And the key message is that long-term horizons, you should move more towards a more equity component part. And if you have less liquidity needs, so if you are accumulating money, which will do in the next years of your life, because you start having a job, you start paying your rent, but you still are able to you still be able to save for your retirement. So the profile like this should be moved more towards equity. If you as you move more towards retirement, you start having the lower time horizon and start having more liquidity needs. So you should reduce your equity exposure on your portfolio if that's the case. And another important aspect that I want you to leave this presentation on is not normally people are a bit. Miguel will speak about that, but there is a lot of biases. Okay, and sometimes people say, okay, I'm a Portuguese and I want to invest in Portugal as an equity market because I know the companies and they are in newspapers, headlines. I mean, I'm more familiar with it. And normally that's not the best idea, okay? So the best idea is to have a broad-based exposure, diversified as possible. And here I brought the MCI World, which holds more than 1,400 stocks and broad-based exposure around developed markets. And you see that performance was much better than the Portuguese stock market, and even more than have just a single security that sometimes doesn't goes as expected, and people end up losing a lot of money and say that stocks or equity investing is bad. But the thing is that you should at least broad base at least a great deal of it in order for you to be exposed to global economy and to global growth, and not just growth of a certain geography or of a certain sector of a certain stock. So this kind of risks is called idiosyncratic risks, and as you know, probably you are better off diversifying from them. The thing now that some of you that might be convincing to invest is that okay, I will start investing. That's fine, but I will wait a couple of months so that the stock goes down, because now it's a bit elevated and so on and so forth. And what I wanted to convince you is that if you will invest throughout the years and for a long time horizon and do it every year, it doesn't play really a difference whether you buy at maximum or to buy at the minimum, okay? So let's consider three characters. The first one, which is the brightest mind, that purchased the S&P 500, let's say that all of them invest $2,000 per year during 20 years, so 40,000 at the end of total investment. And this first character, the brightest one, invests on the cheapest day each year, on the cheapest day of the S&P 500. And there is the most unluckiest person on earth that purchases on the maximum on each given year. And then there is the guy that's always waiting and invests just in treasuries, okay, for 20 years, which is considered a long time horizon. He invests just in equities. Let's see how they performed. As you can see, the brightest person outpaced the unluckiest one by around 2.5%. However, the unluckiest one outpaced the one that was always waiting for the best time and never invest by twofold. Okay, so basically it doubled the return of the guy that never invests. So the difference between the luckiest person or the brightest person and the most unluckiest is significant, but it is of less magnitude than the unluckiest and the guy that never invests. So you should not just be too concerned with the right timing, as long as you start investing on when you have your savings to do so, okay? And to finalize, I want to leave you with an example. This is a fun story and a personal story. My nephew just born a year ago already, and when he was born, I told my brother, okay, let's start. I brought Monte Carlo, which most of you are probably familiar with. I brought a Monte Carlo kind of simulation. I said, okay, let's invest the initial gifts and from the christening and the gifts that he receives on Christmas and on anniversaries on the S&P on the ETF of S&P 500. And I brought here the kind of probabilities, and with 50% of probability of a total investment around 10,000, you will more than triple at the age of 23. So when he leaves university and needs the money. So in the best 25% cases is more than multiply by 5, and even in this with 75% of probability, in more than double. So here I leave you with sometimes some creative strategy for yourselves and for the ones that you care, that investing is actually a good thing for you to accomplish more in your life and to increase your net worth, and doing now with some creative ideas and investing, even if it is not that much, but it's a good start, and that's, I leave you with that, and I will pass the floor to Miguel. go and finish it up with and speak about the biases. By the way, my nephew is already getting 12% even after this global pandemic and this kind of thing. So he's investing for less than 1 year. 12% is not bad, right? Miguel?
Good. So thank you, Raúl. So let me just get my screen. Yeah. Okay. So sorry, I'm just need to. Okay. Yeah. Okay. Sorry, just a second. This one. Okay. So I take it everyone can see my screen. Good. Right. So my colleagues have spent the past few minutes discussing about, coming up with a template, a structured approach to investing. And it doesn't seem the most complicated of things, right? You just need to be disciplined, you need to be patient, and you need to know, to have some consistency in what you do. And so, of course, as we know, this isn't always the easiest thing to do. And the main reason is essentially lies in us. And it's very difficult for human beings to fight some inner drives to do things that sometimes are not too rational or that lead them to make suboptimal decisions. So I'll spend the next few minutes discussing behavioral biases, so we can really split them in two main families. So the first one is the cognitive one. So good news is that we can, as soon as we become aware of them, we can, through a lot of hard work, we can learn how to control for them. And then the second one is the emotional. So these ones are trickier in that they deal with emotions. So a lot of times we're compelled to act just based on urges. And so these ones, I guess it's helpful to be aware of them, but these, just so you know, they're harder to manage. So I guess it's helpful to just know and stop yourself when or have a very disciplined approach that sort of takes the emotional side of things when it comes to investing. So without further ado, let's jump into it. So the first one is actually an exercise. So I want you, I'm at the casino and I'm with friends, and so I decide that I want to play the roulette. And so I'm playing 100 euros and things are going really well. So I just made 400 euros playing. And so I continue to play and end up losing 500 euros. So really what I'd like to know is how much did I lose? So for that, let me just launch poll. Hopefully you see the poll. Good. So, okay, still quite a few to just wait a bit more. Yeah, I think 2/3 of vote. Yeah, okay, 70%, that's fine. Okay, so really, as you can see, 64% of you said that I lost 100 euros when in fact I lost 500 euros. So really, this mental accounting bias is one where we tend to treat money or give it a different level of importance depending on, where it comes from. And so really here, I started with 100 euros, I made 400. So in essence, I had 500 euros, but somehow I decided that I'm playing the profits, and if I lost everything, I'm just down to 100, but that's a lie. I had 500 euros and I lost them. So mental accounting, when it comes to investing, is really our way to take, our urge to sometimes take more risks than we should, just because money, we're playing the profits, and so we're compartmentalizing money, which is, 10 euros is 10 euros, right? It doesn't matter where it came from. It has the same value. And so this is one where we, sometimes often think it has different values. And so just become aware of that and try. Next time you go to the casino, remember me and my words. And so just moving on to the next one. Right, so the availability bias is really one where our brains try to trick us and make us overplay or overemphasize information that is more recent, frequent, extreme, vivid, and negative. So let me give you an example, a very practical one. So let's say, you know, an airplane, right? So a lot of, as most of you I'm sure know, it's very safe to travel by plane. And yet, whenever there's a crash, it comes on the news, it's called quite scary. And I suspect a lot of us actually often feel uneasy when we're, you know, in a plane, when in fact we tend to, just because we remember all the tragedies and all that, but it's so unlikely that, you know, if we compare it to driving in a car or any other form of transportation, the odds completely, you know, show a different story, right? So this applied to investments will often make us, you know, let's say Raúl was talking about the example of investing in Portuguese companies. And so a lot of investors, probably older than you are, have had past experiences or bad experiences of investing in Portuguese equities. And so they will look at equity investing and say, no, I'll just lose my money. And so again, Raúl was trying to show you that actually the world is far larger than just Portugal. And so the importance of being diversified in your revenue sources and, you know, and really, you know, in the companies that you invest in is super important. And so also become aware of that, and especially in discussions when, you know, just try to think logically, and probability weighted decisions will definitely help. So yeah, so that's the second one that I want to talk about. Now, I guess we can move into the emotional biases. And by the way, there are a number of biases in each front. I'm just discussing a few. There are a lot of great books on it. So later on, if you have an interest, I'll be happy to share some names. But yeah, so now onto this next one, I'll launch a poll and I have a game for you. So the option, I'm giving you two options really. So the first option is you pay me 50 euros. The second option is heads or tails. Heads, you're flat. Tails, you have to give me 100 euros. So I'll just launch a second poll. So I guess should be this one, and we're good. Right, I think we have, yep, I think most of you have voted. So in the interest of time, I'll just stop here and share the results. So 2/3 of you roughly wanted heads or tails. And by the way, I know, and I know that you all assume it's the same expected return. So I'll stop sharing. So now just, yep, okay. So we can move on. So another game. This time, option A, heads or tails. So heads, flat. Tails, I'll give you 100 euros. And option B, I'll just give you 50 euros outright. And so I will just launch to know your preference. Yeah, I think I can stop here. Most of you have also voted. It's fine. Right. So interestingly, you know, when it comes to receiving, our brains tell us that we always prefer to take, you know, to receive money, 100% sure money. So 71% of you decided that they prefer to receive 50 euros outright instead of gambling. So this, you know, this is in a nutshell loss aversion. So we hate to lose money. It's our human nature. We don't like to lose, and so losing in general is bad. So really the pain from loss is larger than the pleasure that we get from gains. And so really when it comes to investing, a lot of times we will continue to have bad investments and refuse to sell them just in hopes that, you know, one day we will recover. And yet, instead of just, you know, ending it and moving on with our lives and applying that money elsewhere in a better opportunity, we just sort of let it drag on because we don't want to recognize the loss, right? And so this one is very difficult. It's super tricky to manage, and it applies not only to investing, of course, but you know, this is something that sometimes leads us to make suboptimal decisions. And so just be aware of that. Always try to reassess opportunities from a standpoint where you ask yourself, if I were to invest today, would I want to own this company, or am I just staying around because I want to recover my money? And so this should, you know, in essence, help you sort of always, you know, do sanity checks in what you're doing with your money. So next one, I guess the final one really for today that I wanted to discuss is herd mentality. So this is very difficult to, you know, to control for, to avoid. And so, you know, all of us have friends that often come up with new ideas, latest hot investment opportunity that is going to make us incredibly rich. And so a lot of times, just maybe an example from, you know, not the investment world, but think about Black Friday, which is such an interesting and weird event where, you know, especially in a day where you have Cyber Monday, people still, you know, get exposed to these sort of situations where, you know, it seems very, you know, very annoying and very disturbing to be in these conditions just to get some form of discount. And why? Because, you know, there's a whole event around it where everyone is going. And so if everyone is going, I should also be going. But you could also wait a couple of days and buy probably the same articles at very similar discounts from the comfort of your home. And yet we still see these sort of crazy events happening. And so this sort of phenomena of herd mentality also applies to investing and investment opportunities. And so here I want to show you just a few examples. I mean, this information is probably updated towards sort of the start of 2020, I guess, in the case of Bitcoin. But really, here we're not discussing the merits of these opportunities. What we're discussing is the way in which they come and, you know, their capacity of forming bubbles, right? So bubbles come as a result of human behavior, where everyone is, you know, following the same opportunities, and then, you know, whoever is left to close the door will sort of get burned. So really, it's just a numbers game. And so what I want to say here is, every time someone comes up to you with an opportunity, always be a bit, you know, cynical and ask yourself, why me? And what exactly do I know, or does this person know that, you know, the whole world is not doing? There's an information flow where, you know, typically an opportunity is good until it stops being good because a lot of people have exploited it, right? And so I guess a useful toolkit is for you to be very cynical when it comes to analyzing opportunities, to think for yourself, not just follow, you know, whoever's doing this because it's, you know, the latest, hottest thing. And so this is a critical analytical toolkit for, you know, investing, and that I wanted to share with you. So I think that's it for today, and I'll pass on to Madalena, who will discuss investment products in Portugal. And so, you know, let's catch up there in the Q&A. Thank you. So, Madalena, over to you.
Thank you, Miguel. Hi, everyone. My name is Madalena, and my objective today is to help you put theory into practice, basically. So we've been talking about how we can, so the importance of investing, how we can save in order to invest. And now my objective today is to actually give you some insights about how you can actually invest. And with a focus on the Portuguese market. So I've divided the financial products today into two main categories. So the guaranteed and the non-guaranteed products. What does this mean? So the guaranteed products are those that have virtual zero capital risk. What does this mean? This means that you invest your money and you have virtually no risk of losing the capital that you have invested. So this means that your capital is guaranteed. The non-guaranteed will, of course, have this risk. So in terms of risk and return, of course, the guaranteed products will have lower risk, but also this comes with a price. And so this lower risk also means that the products will have a lower return. And then the non-guaranteed products, on the other hand, will have higher risk but higher return. And taking this into account, I wanted to launch a very quick poll just to ask you. Sorry, just 1 second. So I want to ask you. So we have one of my colleagues have mentioned the emergency fund. So this is actually where you should put some money in case you need it for an emergency. So which of these two products, the guaranteed and non-guaranteed, you think are more suited for you to invest in your emergency fund? Just want to check that your understanding is right. So most of you have voted now. I'm going to end the polling and share the results. So yeah, most of you are right. So when we consider our emergency funds, we will want to invest it in a place where we don't have as much risk, because our objective is to have it available for when we need it in an emergency. So it's actually better to have it in a safer place. Okay, so I'm going to start by talking about the guaranteed products in more detail. And I'm going to start by talking about deposit accounts, which I'm sure most of you will be familiar with, but just a brief introduction. So we have the current deposit accounts, so depósitos à ordem in Portuguese, and you have the savings deposits account, which is depósitos a prazo in Portuguese. So in the first one, you put money in the bank and the money gives it back to you when you want to withdraw it. In a saving deposits account, you also put the money in the bank. The money gives it back to you, but it gives you the money that you've put in, but an extra. This extra is called the interest rates. It can be fixed or variable. So for example, it can be 1% per year, or it can be linked to, for example, Euribor. So it would be, for example, Euribor plus 0.5%, for example. Unfortunately, the rates are not as high as I've just told you at the moment. And so just to give you an example, the average interest rate in Portugal last year was 0.08% per annum, so really low. Which is fine, because actually you want something, you want a place to put your money with low risk, but as I said, it also comes with a lower return. The second guaranteed product I want to talk to you about is the government debt certificates. So this is actually money that you lend to governments in order to fund public spending. And here I'm categorizing this as a guaranteed product, but this actually will depend on the credit risk of the government issuing the debt. So this basically means it is only considered guaranteed if you believe that governments will pay you the money back. So if you are talking about, for example, a German bond, so you are lending to the German government, then you can consider this investment as guaranteed, because you are almost sure that Germany won't default on its debt. But on the other hand, if you are talking about some emerging markets, for example, then this won't be the case for sure. So this is something you need to take into account, and also the returns will depend on how guaranteed your money is. Just to give an example of Portuguese bonds, so government debt certificates, there are currently two in the market, certificados de aforro and certificados de tesouro. I won't go through all of this, but just to highlight the main differences. So minimum investment in the first one is lower, and then in terms of the redemption terms, in the first one you are able to actually withdraw your money after just 3 months, whereas in the second one you have to wait 1 year until you are able to withdraw your money. So moving on to the non-guaranteed products, and I'm going to split them in three main types: passive, active, and direct investments. So in the first in the first two, you are actually giving your money, you are delegating the responsibility of managing your money to a team that is specialized in doing this, whereas to a fund manager. Whereas in a direct investment, you are doing it yourself. Basically, you're choosing whether you want to invest in Google, Amazon, whatever you want. You'll do this choice yourself. So in terms of the different objectives, so in direct investment, your objective will mainly be to maximize returns, so to get as much as you can. In passive investments, the fund manager will have a benchmark to follow. So the manager will want to perform in line with that benchmark. So for example, if we have a world equity manager, this manager will want to follow, for example, the MSCI World Index. In active investments, the manager will want to outperform this benchmark. So we'll want to have a higher performance than the index. In terms of risk, this really depends on the asset classes that are inside each of the types of investments. So if the risk depends more on whether you are invested in equity or bonds, for example, in which case equity would be typically more risky than bonds. So it really depends on the asset classes that you choose within each type of investment. In terms of complexity, direct investment really has the highest level of complexity because you really need to know the companies you are invested in, or at least you should do. And you need to take some time and effort to choose the right companies to invest in, whereas in the other two, whereas they can also be very complex, the complexity is perhaps lower than direct investment because you are delegating this to an expert. In terms of management fees, I wanted to hear your views about that actually. So I'm going to launch a second pool and ask you which type of investment you think has the highest management fees of these three. So passive, active, or direct. Okay, most of you have voted now. I'm going to end polling. And actually, most of you are right. So let me close it. So it is true. Active management typically has the highest management fees because you are paying to this expert to outperform the broader market return. So you actually need to pay them for their expertise and for their research, etc. So I'm going to focus on passive and active for the rest of the presentation. There are, of course, other types and other products that I won't talk about today, but I thought I would choose the main ones which I think are appropriate for an introductory section. So in terms of passive investment, I'm going to talk about ETFs. As for active, I'm going to focus on mutual funds, individual retirement funds, the Portuguese might know this as PPR, PPR, and then also pension funds. Starting with the ETFs. So ETF stands for Exchange Traded Funds. And this basically is an investment fund that aims to replicate the return of an index. So it has a basket of various stocks, various securities, and you can actually trade them on a stock exchange as if you would trade an individual stock, for example. As you can see from this chart, so the green bar is showing the performance of the ETF, and in blue you can see the performance of the index. They basically overlap, and this is meant to be because the ETF is supposed to replicate the return of the index, so it's doing its job. It is doing its job. In terms of key factors that you should consider when you are choosing an ETF, the main one I would say is which asset class, which index basically you want to track. So do you want to invest in equities, do you want to invest in bonds? And this will actually determine the risk of your portfolio and also the expected return that you might get. Something else to consider is the types of share classes that there are available. So you have accumulating or distributing. So as you probably know, companies often distribute dividends to their shareholders. If you are invested in a distributing share class, this means that each time companies pay out dividends, you receive them. In an accumulating share class, the fund itself will reinvest those dividends. So you won't receive them when they are paid, they get reinvested in the fund. So this is for ETFs. Then moving on to active investments. And just as a quick reminder, so they are aiming to outperform the benchmark. And then another key message is the risk of these investments really depend on the asset classes that are included within each structure. So these are different structures of investments. The actual risk and return characteristics will depend on what you choose to put into each of the structures. So a mutual fund is actually an investment fund. So as I said, so all of them you give your money to a fund manager, an expert who will manage the portfolio to a specific guideline. The main differences between each of these three is in terms of how efficient they are fiscally. So the mutual fund will be less efficient fiscally. You don't get any fiscal advantages when investing in a mutual fund, whereas in a pension fund and in an individual retirement fund, you tend to get some fiscal incentives. So you pay lower fees, lower taxes basically when investing in these two. However, the catch is in an individual retirement fund, and especially in a pension fund, you are not able to withdraw your money that easily. In fact, in a pension fund, you are typically, except for some exceptions, you won't be able to withdraw your money until you get to retirement. In a mutual fund, however, and somewhat in an individual retirement plan, you can do this more easily. In a mutual fund, you can take this out whenever you want, and in the individual retirement plan, you can do this, but you might lose some of the fiscal benefits that you have gained so far. We can obviously discuss any questions that you have specifically for each of these types of products. But before we move on to Q&A, where we're happy to answer all your questions, I would like to finalize with two things. So the first thing is I'm going to launch a final pool just to understand if we made a good job today. So basically, we want to know which financial instruments you will start investing in after this workshop. You can choose more than one option. Basically, I really hope that after this session we have convinced you, or at least taught you more about investments that will allow you to invest. For some of you, start investing with more confidence and know-how. So I can see some responses right now. Most of you so far will invest after this workshop, which is a good sign. Just a few more seconds. Okay, so most of you have voted now, so I'm going to end the polling and show you the results. So most of you said you would start investing in ETFs, so that's very, how do you say, very popular. Also government debt certificates, direct investments as well. Some of you still want to know more before investing, which is fine. So so that's great. And then finally, just to end with my personal story. So as most of you, I have studied economics and then I studied finance in my master's. I work in the financial industry. I have been since the last 7 years, but it was only recently, so a few years ago, that I started giving more importance to actually saving and investing my personal money. And my advice to you is don't wait as long as I did. Please do this as soon as you can. And it's really important that when you start working and you start your professional career, you have this mindset. And we really hope, all of us hope, that we were able to teach you something today. At least some key takeaways would be: start saving, start investing, and I personally think that's a good idea, and don't wait as long as I did. So thanks a lot for listening. I think we can now open the floor to Q&A. So you can either just tell us your questions using the audio, or if you prefer, you can write them in chat. Not sure if there will be someone.
I will.
Okay, thanks,
Madalena.
Pedro.
But ask me to do this because he doesn't have a good connection. So
Sure.
there is one in the chat. It can be to you. It's easy. Can we invest in international government credit certificates, or just in our own government?
No, you can invest. Yeah, you can invest in other countries if you want to. So you don't just have to invest in the country where you live in.
Yeah.
That's basically it.
Yeah.
Let me just, if I may, complete
Sure.
a bit. There are, as Madalena was saying, the ways to invest in the markets. You have through structures like ETFs or funds, or directly. Usually directly, it's you need a large amount to invest in a bond outside Portugal. And the Portuguese products that were mentioned were not actually bonds, was the certificates. So this type of products usually are for residents, but for the general bonds, you can invest. Usually the best way to invest in foreign bonds is in a mutual fund that diversifies across a lot of countries, or in an ETF that also does the same job in a more passive approach.
Okay. Now I have one very interesting question that I still have this issue. How do you find the appropriate balance in your portfolio between fixed income, equity, commodities, others, class of assets?
Yeah, I can start. Then I'm sure my colleagues will also want to step in. So really, I think we can also probably we should also discuss my colleagues discussed the topic of investment horizon, and really it's super important to answer your question, in that your balance should also evolve as you grow older, right? So what do I mean by this? We're all relatively young, I guess, and so it means we have a 40-year-old 40 years of an investment horizon. This means that we can be much more flexible in terms of what we own. And probably, if we're on the younger side, we should be leaning more towards equities, right? I mean, a lot of people advocate for 100% equities at a given age, more or less around our age. So, I mean, I wouldn't go against them, but it's just my view. My colleagues may have different views. As you grow older, and so let's say you're now 65, and then you've sort of, close to retirement or have retired already, and then you have a family, your investment horizon is shorter. This means that you don't have the same time to recover from sort of a potential crisis or anything. You remember what Raúl said about crisis, right? The average was 4 years, but there were some that, actually took longer. And so obviously you don't want to, you want more safety, right? So bonds are inherently safer vis-a-vis in terms of the risk return profile. So they bring you a regular stream of income in some cases. And so it may fit better for your, objectives at that point in your life when you sort of, don't want to take a lot of risks and you just, are happy to get a regular income. So my answer to your question is it changes over time and you should continuously look to reassess it. And yeah, I don't know if my colleagues want to also add.
Just want to add something. So you mentioned, for example, going 100% equities. One thing that it's important to consider there is, okay, you can invest 100% in equities, but it is important that that amount is diversified within equities. So as Raúl has mentioned, don't go all for the same company or all for the same country. It's important to be diversified, even if you decide to go 100% equities.
Okay.
Yeah.
Not sure if someone else wants to add.
I'll also, yeah, no, good. On the books, I'll just type in the chat. I think it's easier so that everyone can sort of, okay. So you can move on with the questions. I'll just be typing.
So there is one interesting. What is the difference between ETF or a fund? Anyone?
Sorry?
What is the difference between an ETF and a fund? Active versus passive investment.
So
basically,
I can answer.
For agent, right? But Pedro, you can you have the mic off.
Yeah. Exchange traded funds, like the name indicates, are exchanged in a facility, in a market, a regulated market, typically. A mutual fund, at least here in Portugal, you will find a lot of mutual funds that are related to banks that have management companies in their structure, and that offer different flavors of investment in order for the investor to subscribe or redeem the shares of each of the mutual funds. So it's the structure. It's a little bit different. In the case of the mutual funds, you subscribing, you create the share. When you redeem, you eliminate this share. In exchange traded funds, you are swapping the position with some other investors. So I think the way to put it clearly is like that. I don't know if the doubt still stands or not.
Okay. I have another one. This is a funny one. Funny, no, but this is personal, so it's for all of you. Supposing that you are still saving, what is your monthly research allocation in terms of your income? How much do you target to save on a monthly basis or annual basis? Anyone can respond to this one? I can reply because in my case, I try to do at least 50%, 50.
Me too, actually, because I'm in a position where I can do that. Some people can't, but yeah, same here.
Yeah, I try to achieve that amount earlier in my life. Nowadays, it has to be a little bit narrower now. If what I aim is to be able to do 10% for the time being. I believe when you have kids and a home to buy and so on, that's like the at least you should aim to do this.
I'm currently living of investments, so when I work and get extra income, I save it 100%.
Oh, I meant to, yeah, more or less around that, not the 50% per se, but I guess it really depends on what you do, right? So my former job now, you get a point in the year where you're awarded a bonus depending on your performance, and knowing that you can sort of make a conscious yearly decision to allocate a substantial part of that to investing. And so I guess it's a bit different. So I would mostly decide, on that year, on that point in time every year to, how will I do it? And so sort of implement it throughout the year. And so, yeah, that's my answer.
And me to finalize, I mean, it depends on the month, but most of the months is more than 50%, and then you have several months where you expand some. But I believe on average it tends to go around that lines. And currently I invest 100% equities. That's my current allocation.
Okay. So next one, do you recommend any specific forms intermediaries? What are the criteria that you use to consider a good one to put your money there?
I think, I mean, we should not recommend intermediaries. You should do your own research on it. There are the things that are very important. First one is costs. Okay, so you want to be able to save and invest on a periodic basis, and you need to see whether the investment costs are a burden. And the second one is security. So some of those assets are protected and by insurance, and you need to see if your amount is already over that. So basically in Portugal you have some brokers that work quite well in terms of costs. After you get over some amount, you probably get better brokers, or brokers that are a bit more secure, that are listed on stock exchange for some years. Look to their books as well. Off the back of my mind, for instance, personally I use interactive brokers for it, but for instance for my nephew I used the Zero because the amount was much lower. So that is my personally the ones that I use the most, but there might be other experiences.
Okay, so next one, do you believe we should rebalance the portfolio depending on the macroeconomic conditions? The assets that tend to perform better in certain environments?
I think it really depends here on the professional side. What we do is what's called asset allocation, and that technical asset allocation. So the asset allocation is more what Miguel Jordão said, that is more long-term, based on your goals and objectives and horizon and financial needs and whatever. And you can make some tacticals in between. If you think stock market is too high, you might sell a bit. If you think stock market is too low, you might buy a bit. But on boundaries that make sense. You don't go all in, or you don't change everything just because Financial Times post the news that next catastrophe is tomorrow. Okay, Financial Times, and no. If someone knew, that person will probably be rich already. So the best leading indicator of the world is the market itself. Okay, because if there was a leading indicator better than the market, that person would perform on a consistent basis, and that information afterwards would be already in the market. So in terms of trying to adjust a lot your investment strategy, I think that your investment strategy should be based on your core objectives and time horizons and financial needs.
Okay. Next one. What's your opinion about leverage ETFs?
Avoid.
Yeah, exactly. Avoid. No
No,
good.
sorry. I mean, we can clear. I mean, sorry. We can quickly. It's mathematical. The answer. Sorry. It's just you want to. I mean, you can either be a day trader. We're not focused on day trading, or this is really for investing. So provided you are investing, this is a poor instrument to invest just because of the way it works, right? So when it comes to leverage, and as you know, when something goes up, let's say 20%, then it goes down, let's say 20%, it needs to go up 30% to go back to the starting point, right? And so this sort of imbalance of going up and down, when you magnify it with leverage, it just becomes a disaster. So you will see a lot of ETFs because of the way they're structured. It's mathematical. You can just simulate the returns of any given index, and then you will see that if you do it 3 times the amount, and then you're magnifying the jumps but also the downs, but you're not replicating the movements of the index perfectly, and so it's just not advisable to use as an investment instrument. So I think inherently all leverage ETFs sort of tend to go to zero, just just from the way they're structured over time. But I don't know if my colleagues want to add anything. Maybe I was a bit too...
Yeah, just one part that is really important about this question and Miguel's answer is that you have to always consider what is inside the investment. Just the name of the instrument usually doesn't satisfy. So you can have an ETF, for example, in this thing, it's can be a conservative investment because it's a passive index approach, or it can be extremely risky and it's a leverage 3 times ETF. So just listening to someone say, okay, I invest in ETFs doesn't say a lot. You have to dig into what is in the instrument, and the same is for equities or bonds. You can have sometimes equities is less risky than some bonds when it's high yield bonds, extremely speculative bonds. And so just going, okay, bonds are safe and equities are risky. And that's a very general approach. You then have to look into the instrument itself and then take the conclusions.
I just want to add one thing that doesn't really add up to it, but the risky thing sometimes is not fulfilling your goals. Sometimes imagine that you want to buy something in the future and your horizon is 40 years. Sometimes the risk is not getting enough money to fulfill the objectives that you propose at the beginning. So if you are very conservative and you have a very long time horizon and you propose yourself for something, the risk is not the volatility in between, okay? That's called volatility. And so sometimes we use the same words for it, but the risk is not getting what you want of investment. That's really the true risk of investing, is not getting the ultimate outcome. It's not just the between. The between, you should deal with it and learn to deal with it as you go.
Okay. Next one, assuming that you are a long-term investor, should we be less concerned about short-term volatility and more concerned with more growth potential opportunities like emerging market equity ETFs?
I can also start there, or Raúl, if you want to. Okay. Yeah, so with emerging markets, I think there's an important distinction between what is growth and what is a good equity investment, right? So oftentimes, we believe that country X or country Y is developing at a rapid pace, but that does not necessarily translate into a good investment when it comes to investing, shares of the companies there, right? For a number of reasons. So, with bonds, as you know, typically these countries, especially more emerging ones per se, they will have a lot of credit issued or bonds issued in dollar or other stronger currencies. At any given point, any swings on the interest rates in the US can have a magnifying impact on these countries. So there are a lot of implications also on the equity front. A lot of governance differences across countries, a lot less control. So you can also think a company looks great, but no one is really checking if the numbers are there or not. As you can probably see, even in Germany, you get that happening to this day and age. If you saw what happened with company Wirecard this week, or last week, really. So I guess to answer your question, yes, absolutely focus on companies that you think are going to be great. But the great thing about, let's say, investing in an ETF of the S&P 500 is just the way the ETF works is to always give you exposure to the 500 largest companies by market cap, right? So the constituents will change over time, and some will grow, and it means that their weighting in the index will just grow larger, right? So it's like you're permanently exposed to the greater companies in America and in some sense in the world, just because of how global these firms are. And so yeah, that's my answer. I don't know who, if you want to step in. Okay.
No one? So next one. And this one it's for Raúl. Raúl, thinking that, supposing that, or not, there are 4 years average for in each crease to the S&P recover. The S&P is trading 6% lower prior the prices before the crisis. If you have, let's say, 2,000 euros to invest, 1,000 maybe probably it's not the best number, but maybe 10,000 to invest. Would you directly invest everything at once now, or would you divide your investment in several tranches to mitigate the market risk?
Federico, are you from Nova? If you are from Nova, invest it all at once. You'll get much more in the future. No, the quick answer is it depends on yourself. I think today is the best day, but if you don't feel that comfortable, just divide it in 3 times or whatever you feel comfortable. But it depends on you. But probably will not do better than investing at once. At least if you do it several times. I mean, if it is just one shot, probably you might get a bit better. But if you just get the noise, is basically the difference between the smartest kid and most unluckiest. The unluckiest one, it will just be noise. I mean, on over 40 years, I mean, that doesn't matter really.
Yeah. There are more 2 questions. This one, I think we should consider also short-term opportunities as the one we experienced during this pandemic. And the guy provides the examples of crude oil and the major US index. No one?
I mean, I think most of it we already tried to answer. I mean, your ultimate goal should be based on your asset allocation, which is long term, okay, or at least adjusted for your time horizon. Of course, you can have some of it to just try to outpace and get better results, but should not be a substantial amount of your portfolio. If you go as some friends I have saying, oh, now oil is cheap, I will buy 100% of my wealth in oil. Well, just if you want to become an oil dealer, go forward, but I mean, as an investment, not with 100%. I mean, you might be right. If all oil dealers are trading at that prices because they cannot get rid of it, that's it. So it's a problem. So if you get to the eye of the hurricane, probably you get crushed. I mean, and you need stomach for it. The thing is that you need really stomach for it. Sometimes it's not the best way is not to get in crisis, because even though it's the best timing, it's very tough. I mean, you lose 10% in a day. I mean, it's no joke.
Yeah. Usually if you have in your investment plan to take advantage of crisis, it might make sense. So you have a reserve for special situations and you are prepared for it and you deploy that capital when it arises, it makes sense. But also every time in a very programmed way, not to, because the worst you can do in a crisis is to be led by emotions and then destroy your investment strategy. So I would say everything is possible, and it's a good opportunity because we know from markets history that we'll have some crises. So sometimes they are more likely than others. Sometimes they come out of the blue, like this last one, and no one was predicting a pandemic. But we were 10 years into a bull market, so it could happen for other reasons, and you could have some capital waiting to be deployed on that time. But if the most important thing is that it is in your plan. And actually, if you write your plan and there's a very good investment contract, for example, in the Intelligent Investor, the Intelligent Investor, the book, it's if you have rewritten rules, you are way ahead in terms of investment results, probably, if you follow the rules, obviously, which also sometimes it's difficult for investors. So you can have that in the plan and take advantage in that situation. You can also, in terms of rebalancing, we were talking a bit earlier about asset allocation. If you are not 100% equities, for example, then probably when the market collapse, the equity weight will go down substantially. The bonds or the more secure part will go up in terms of percentage, and you can take the opportunity to rebalance when there's this collapse, so buy a bit more equities and sell some of the safe assets. I think those are the main approaches.
Okay. So the last one, and this question is for Madalena. In an emergent portfolio, won't be investing on fixed maturity government contracts counterintuitive since the liquidity risk you would face? Can you renegotiate this contract with the bank?
I'm not really sure I understand the question, but just to give like an overview about what is important in an emergency portfolio. So ideally, you'll want this portfolio to be available in case you need the money for an emergency. So what is important about this is that, so if you have 1,000 euros in an emergency portfolio, you want it to be invested in a place where it does not, that is not very volatile, so that you don't have the risk of when you want to get your money, it's a very bad period in markets, it's a crisis, and you actually need the 1,000 euros and you don't have them because the markets have gone down. So ideally, you'll want to put this in a place that is safe in the sense. It also should be in a liquid place, so that you can easily take it out. So you shouldn't put it in somewhere where it's not possible to take them out shortly. So you also need to take that into account. But I'm not sure I've answered your question. So not sure if...
I think I can help.
Sure.
In some government product, the certificates, the FOR and so on, there is an initial period. You can't, I don't know the word, hesitate. Sorry, my English is
withdraw. Yeah,
withdraw,
you
exactly.
cannot withdraw your money. Yeah.
Yes. So you must be careful with that because there is a period that you can recover the money, but this is a temporary period. So I think that's the point. I don't know. So there is here another question, but I guess we already talked about platforms. There is one more personal for Luís. I don't know if he wished to reply. Maybe private. And there is other about how did you manage your personal portfolios during this pandemic? Any change? What did you learn from this shock in terms of investment mentality?
I have some liquidity and I purchased more. Unfortunately, not at the bottom. I still had a lot of drawdown, so I purchased in the first 10% and another part in the around 50% from the maximum. But currently, I'm already positive. The swing was very fast as well. I was not expecting as fast as it was. But logic is as Luís says. I mean, if you have some liquidity at the time of a crisis, and you have more than 4 years of horizon, it's good to deploy it.
Yeah, and I can say that this crisis, comparing with the crisis between 2007 and 2009, this is not a crisis. So this, at least for me, this was really relaxing, because the S&P decreased 30%. I have the experience that the S&P decreased 70%. So this one was much better.
At least not yet, right?
Yeah,
Yeah,
exactly.
at least not yet.
I wanted to say
Exactly. Too early. Too early.
Yeah, right.
I think just regarding the comment on the liquidity, you also have to be very careful not to abuse it, because I also know people that have liquidity since 2012 waiting for an opportunity to get in, and then it's not even close to the levels of 2012. So it's a small line to cross between being a speculator and investing with a plan and taking advantage of opportunities that might occur. So,
but I think I can also segue to what Luís was saying just a few minutes ago, when we were discussing, having some room to take advantage of special situations when they happen. So I think, and also an important part to, of this process is to already have the names of the companies or the products that you're going to invest in when the opportunity comes. It's very important to already have that very well structured in your mind. It's not about chasing opportunities as they come, right? You see company X is suddenly, trading down. Oh, who are these guys? Let me research them and then buy, right? It's not about that. So have a watch list. If you want to go direct, or if you want to go, thematic ETFs or something, have a watch list, start reading, take your time, don't rush. So, to answer the previous question of, for my example on during the pandemic, so I have quite a sizable watch list, and so really that allowed me to, maybe for over a year or 2 years, I've been following some names, and you sort of start to get a better sense of, okay, this is really, really cheap for this company, because you have, sometimes when these events happen, there's a lot of panic selling. So good businesses and bad businesses get sold. But there are a lot of good businesses, but you need to know who they are before, not after the event. So it's very simple to just top up when it happens, because you already know the businesses.
Just regarding the moves in this pandemic, I took the opportunity of one asset that I was looking for a while, and it was always escaping me, which was Amazon. So I took the opportunity when it fell, and it went into the portfolio, because I have a portfolio of global leaders, let's say, and Amazon was missing. So in this pandemic, I took the opportunity there. And then I also did with an ETF, so not to be very selective, but very high beta play, that was small caps, world small caps ETF that I added to the portfolio. More or less when the market, the MSCI World was down 30%. So I thought 30% was already a good entry point. So it was end of March to get some extra exposure, but especially because in this portfolio that I had, I had the opportunity to increase the allocation to equities, because before it was forbidden. So I took this opportunity to increase the equity exposure. It was the main moves. Nothing else. I think rest was stable.
Okay. So I think we'll finish. There are some questions about CFA certification. We would love to reply about that, because all of us, we are CFAs. That was important in our professional life. We think it's not the topic for this event. As I mentioned on the beginning, there will be an event on the July 17 organized by CFA Institute to talk about the CFA program and CFA certification. So I will send the link with the invitation as soon as I have it. And if you wish, we can join that and put the questions, the relevant questions there. Okay. So
thank you all for your time, and even though Benfica is playing, a lot of people here. Bye.
Thank you, everybody.
Thank
you.
you.
It was useful. Bye-bye.
Thank you. Bye-bye.